Hey everyone, welcome to This Explainer. Today we're exploring a fascinating, honestly kind of invisible world that sits right under our noses. I mean, think about it. Every single day, literally trillions of dollars circle the globe. We buy products from overseas, businesses pay international suppliers, and economies just hum along. But have you ever stopped to wonder how that actually happens? What is the hidden complex digital web that powers global finance?
Okay, let's dive right into this. Seriously, how does $1 million actually cross the Atlantic Ocean? If a business in London needs to pay a factory in Tokyo, does a ship set sail with a giant vault full of cash? Or, I don't know, does a secure cargo plane fly pallets of gold bars across international airspace?
Well, what we often imagine is straight out of a spy movie, right? Secure briefcases and armored transport. But the reality? It's completely different. In the modern digital age, physical cash almost never leaves its home country. Instead, international banking relies entirely on a highly coordinated, totally hidden infrastructure of digital messages and specialized accounting. We aren't moving paper anymore. We are moving data. So, here's our roadmap for today. We're going to break down this global machine into 4 key pillars. First, SWIFT, the messaging postal system. Second, the Nostro and Vostro mirrored ledgers. Third, correspondent banking, which is the connective web. And fourth, settlement, or discharging obligations.
Let's kick things off with pillar number 1, SWIFT, the messaging postal system.
Before we had modern systems, global finance was, frankly, a logistical nightmare. Prior to 1973, banks actually had to use telex machines, which were essentially advanced typewriters sending text over phone lines just to authorize payments. It was incredibly slow, fraught with language barriers, and highly prone to errors. To solve this mess, SWIFT was established in Belgium in 1973. It was created as a member-owned cooperative by the world's financial institutions just to standardize how they talk to each other. Today, this standard messaging framework is the very thing that supports the massive, rapid expansion of global trade.
Now, the absolutely crucial point here is this. SWIFT is not a bank. This is probably the biggest misconception out there. SWIFT doesn't hold your money, and it definitely doesn't actually transfer your money. You have to think of it entirely as the global postal system for banking instructions. When a bank sends a SWIFT message, they're simply mailing a highly secure, standardized letter that basically says, hey, please move this specific amount of money from this account to that account.
But, as you know, for any postal system to work, you need addresses. And that's exactly where the Bank Identifier Code, or BIC, comes in. Every single participating financial institution on Earth is assigned one of these unique codes. It's brilliant because it completely bypasses geographical complexities and language barriers. Whether you're in a tiny town in Germany or a bustling financial district in Japan, your BIC is your precise, unmistakable digital address on the global network.
Let's look at how this builds a transaction step by step. First, the sending bank encrypts all the vital details, the amount, the currency, and who's supposed to receive it. Second, this information is translated into a universal SWIFT code, so there's absolutely zero ambiguity. And finally, step 3, the message is routed through the network directly to the receiving institution. It's secure, it's standardized, and it is lightning fast.
But, that brings us to a really compelling question. If SWIFT is only the postal worker carrying the instructions, who is actually moving the economic value? If the message is just data, where does the money actually live?
That brings us to part 2, Nostro and Vostro, the mirrored ledgers.
What's really fascinating here is the history hidden right in the words themselves. These terms actually come straight from Latin. Nostro translates to our account with you, and Vostro translates to your account with us. Because banks in different countries can't legally or practically settle payments directly in each other's local currencies, they just open reciprocal accounts with one another. They literally hold balances on each other's behalf.
And this brilliantly illustrates exactly how that works in practice. Imagine a bank in Bangladesh needs to conduct business in US dollars. They open an account at a partner bank in New York and deposit US dollars there. From the perspective of the Bangladeshi bank, that is their Nostro account, our money with you. But from the perspective of the New York bank, they look at that exact same account and call it a Vostro account, your money with us. So when a transaction happens, no money actually crosses the Atlantic. The two banks simply talk to each other via SWIFT and adjust their mirrored ledgers simultaneously. One side goes down, the other goes up. Done.
It really is a beautifully elegant system, but it raises another logical question, doesn't it? There are tens of thousands of banks in the world. A local credit union in rural France probably doesn't have a direct Nostro account set up with a regional bank in rural Thailand. So what happens when they need to send money to each other?
Well, that's where part 3 comes in. Correspondent banking, the connective web.
Because no single bank can physically maintain branches or direct ledger relationships in every single country on Earth, they rely heavily on this system. Correspondent banking acts as the essential connective tissue. It allows a bank to gain indirect access to foreign currency clearing and global payment networks simply by piggybacking on larger, much more connected institutions.
Let's ground this with a real-world example. On the left here, you have a respondent bank, say a smaller local bank operating in Kenya. They need to clear a transaction in US dollars for a client, but they just don't have the infrastructure. So they reach out to their correspondent bank on the right, a massive global institution based in the US. The global bank provides the clearing infrastructure for a fee. Just like that, the Kenyan bank accesses the world stage and international trade continues seamlessly.
Now, why should you care about all this financial plumbing? Because the stakes are incredibly high. These large correspondent banks are subject to intense global anti-money laundering regulations. If a region becomes politically unstable or associated with financial crime, the large banks will often engage in something called de-risking, meaning they simply terminate their correspondent relationships in that region to avoid massive regulatory fines. When they cut those ties, they sever the connective tissue, and that can accidentally isolate entirely vulnerable economies from the global financial system. Suddenly, people can't receive remittances and businesses can't import goods. It has very real, very human consequences.
Which brings us to our final pillar, Part 4, Settlement, Discharging Obligations.
Up until this point, we've basically just been dealing with promises and instructions. Settlement is the absolutely critical final stage where the economic reality actually shifts. It's the exact moment where the economic value is officially transferred, and the legal financial obligations between the parties are ultimately discharged. Simply put, the deal is done.
And there are generally two ways this happens on a macro scale. For everyday global trade, institutions use what's called net settlement. Imagine thousands of transactions going back and forth between two global banks all day long. Instead of settling every single $50 transaction one by one, they batch them all together at the end of the day, offset what they owe each other, and only pay the final net difference. It's highly efficient. But for the world's most massive critical transactions, they use real-time gross settlement, or RTGS. These systems are operated directly by central banks to ensure immediate, secure, irrevocable finality, which really minimizes the risk of a massive default.
But here's the big takeaway from all this. Because this entire system relies on interconnected ledgers and correspondent relationships, a disruption anywhere can become a disruption everywhere. It's literally a domino effect. If one major global correspondent bank suddenly fails to settle its daily obligations, that shockwave ripples instantly through the entire global network. This sheer systemic vulnerability is exactly what froze the global economy during the 2008 financial crisis. Trust disappeared, and the hidden infrastructure completely stalled out.
When you step back and really look at it, this whole system is nothing short of incredible. As our source material beautifully states, global finance is a triumph of coordination and trust, ensuring a promise made in one part of the world becomes a realized financial outcome in another. Think about that. We have built a modern world that functions seamlessly without physical cash moving across borders, powered entirely by this synchronized dance of digital messaging and mutual trust.
But as we wrap up this explainer, I want to leave you with a provocative thought. This correspondent system and the SWIFT network were architected decades ago. It's a brilliant, but ultimately aging legacy web of trust. As disruptive digital technologies like blockchain, decentralized finance, and central bank digital currencies continue to rapidly evolve, what new systems might one day replace this intricate plumbing? Will we even need mirrored ledgers in 20 years? Keep learning, keep questioning, and I'll catch you in the next explainer.